this guy worked on about 170 deals. These deals come up to a worth of about $500 million.
Startup is honestly just a new term that's being utilized in the market. Capital comes with no strings attached.
I don't need capital. Vanakkam and welcome to FounderX's podcast on startups, VC and PE. So, how do you do, Karthik?
Perfectly well, man. Thank you so much for having me.
In fact, it's a pleasure to have you here. Been quite a while since we caught up, and really thought that you're the first person that I wanted to talk to about this podcast, and we wanted to have you as a guest because you're right here in Chennai, and you've honestly been running one of the most successful corporate law firms, working with startups and VCs all the time. So, Karthik, before I get started, so I guess you've already gone through the questions, so I'm going to ask the same, right? What do you think about Tamil Nadu right now?
I feel Tamil Nadu today versus what it was 5 years back, we've got startup TN at the forefront. We have a lot of regulation. We've got a lot of subsidies, a lot of encouragement to the startup sector. We earlier had guidance TN, which still exists, which is more the mid-market, the SMEs that they focused on. But you're creating supply to that now. You're linking the entirety of the market from very early stage all the way through to listed entities. I feel like the whole world is talking about how the Indian market is going to be crazy growth in the next 10, 20 years. I feel startups are going to have a huge part to play there. If you see the landscape over the past couple of years, growth to listed entities, growth to PEs has really come from consolidating from the startups. Now, this is a zone which is only going to pick up. We have a whole bunch of unicorns which have grown out of India. I'd love to see a lot more from Tamil Nadu.
Got it. So now that we had your thoughts about Tamil Nadu, let's get down to you. So Karthik, we've known each other for almost a year now, and you were part of our previous conference, but we wanted to showcase you to our community. So, and you matter a lot to me. You're like a brother to me. So, guys, so this guy, the man that I have with me right now, he's worked with about 170 deals in venture capital and private equity just last year. And these deals come up to a worth of about $500 million. So, Karthik, before we get started with the serious questions, can we get a detailed introduction about what you do, who you are, and how you got started?
Sure. Come from a very simple background. My dad's a lawyer and therefore eventually ended up doing the law degree. Tried my hand at going to courts, realized that's not the ball game that I'm able to kind of deal with. That takes a different skill set. Deal making at that point, when I decided I'd give this a go, was a lot slower. Think back to about 2014, 2015, where the startup scene wasn't as full-blown as it is today. And those were the formative years for me in the career. I learned a lot around mergers and acquisitions and quality private equity. And with time came 2017, when we had the Modi government coming up with the whole Startup India. The whole regime came into place. They defined a startup. That's when I started learning about it. And I realized this is an opportunity. You can either choose to just be a part of the back of the wave watching how it pans out, or choose to be a part of the wave, ride the tide, and see where it takes you. And I've always had that little entrepreneurial zeal, which is what really woke me up then, excited me quite a bit. Reading that policy, thinking about what can I do to kind of support and build a community. And for us, building a community is not the same as it has been for you. It's more about trying to educate people about the fact that, sure, the fundamental is going to be focusing on business and ensuring there's that growth. But there's also the aspect of compliance. There's also the aspect of ensuring that your documentation says a certain thing to keep you safe. You're providing for the bad days, right? When the going is good, no one really looks at it. So that was the beginning of the journey back in 2018 in the startup world. And then came a period 2019, 2020, where it started growing. You have the initial hockey stick phase, and then came the pandemic, which hit a reset button. All of 2020 was barely any capital deployed, at least in terms of my experience. And then came 21, which was the bounce back year, which was the period where I think 21 was perhaps the largest deal count that we had as well. We had almost about 500 odd transactions just that year. And that was honestly a very scary year. No one cared for diligence. If you as much as spoke of valuation, you were getting a check. And there was literally a saying, even back then at Bangalore, where they were saying, if you're a founder at a cafe, you are probably likely to get funded. So that was, it was the harsh truth. But I think things are beginning to mature, and it's significantly different from what it used to be earlier. We've had a good bunch of learnings over the years when our team of 40 plus lawyers, a lot of focus goes into the startup and the SME segment, but I personally enjoy the startup space a lot. It's, I feel that initial growth is where all the excitement is. It's where you choose to do things very different from the market. That's where you have the opportunity to disrupt.
Got it. Understood. Now, coming down to the warm-up part. So let this be short answers. So what's one big misconception that people have about venture capital?
They think that capital comes with no strings attached. They often think that there is no pressure to deliver, that it's just funding the idea that you've gotten, but it's really the execution that matters more.
Got it. And then what's one startup deal that you wish you had done?
I've genuinely followed the global startup space. If I could run back in time and educate my younger self, I wish I could have done Uber.
Got it. Got it. Understood. So now going from a lawyer to an angel investor, by the way, he's also a really, really big angel investor. And I want to honestly follow you. Start with small check sizes and work your way up, getting into a lot of deals and having the right kind of exits. So how did you, form Peritum Partners firstly, and how did you get into angel investing?
Sure. So Peritum was really born out of the pandemic. It started in October 2020 with my co-founder. She and I went to college together. And at that point, I was more on the deal work side and she's more on the disputes and intellectual property. And therefore, it just made automatic synergy for better client retention. And with time, we've added more partners and more people to kind of help us through the journey. And obviously, because of the space that I chose to occupy back then in the deal work space, a lot of that work that started coming to us through investment bankers, through CAs, through different advisors, right? And of course, the social network that exists of meeting different founders. You start seeing quality deal flow. And unfortunately, as an advisor, we've also got our Bar Council regulations, which essentially in some form also create an element of conflict of interest, where if you're an advisor to the entity, you can't also be an investor to it, right? This is a very simple layman way of putting it. Obviously, it has its own nuances. And therefore, through the journey where we have also had a lot of opportunities to work on certain transactions, where we've also kind of evaluated, does it make more sense for us to be a part of the investment journey and to support the startup? And that will then come at the cost of us not being able to advise them. But that's okay. Sometimes that journey is actually way better worth. And we've continued to advise a whole bunch of businesses otherwise. That does not mean that we didn't have the conviction that they'd go the long distance. It's more the fact that sometimes it makes more sense to cut a check. Sometimes it makes more sense to be an advisor.
Understood. Now, coming down to building startups, the first section of this podcast is going to revolve around building startups. Now, a lot of people, I think honestly, me, right? I feel that startup is the most raped word today, right? It's the most abused word today. So can you define what is a startup? I don't think that getting a Udayam certificate or an MSME certificate or getting a GST certificate is what a startup is.
Sure. I'm not going to go by the legal definition of it. I think that's easily available on the Startup India website. But I'll perhaps steer away from that in terms of how I look at it. Mm-hmm. Someone that's addressing a very real problem and doing it differently from what the market has is a sign of innovation. And when I say doing it differently, it does not mean it's a different solve to the same problem. You can have an innovative way of improving what someone's already doing in the market as well. Now, I think through 21 all the way until perhaps even current date, we've seen a lot of businesses that have been trying to replicate an existing business model in saying if they can conquer X percentage of market share, I will do the exact same thing under a different brand and capture Y percent. Now, is that right or wrong? I'm not the person to say that. But is that truly what a startup should be? Perhaps not. That's just honest competition where you're mimicking someone who's probably doing it right. But it's about disruption and problem solving for me.
Understood. Now, you spoke about diligence before this. So, coming down to, what are the most common legal mistakes that founders and startups do?
Sure. Perhaps the most important one and most commonly seen is ignoring a whole bunch of compliance. The problem is they often are used to personal banking, right?
Yeah.
Where they set up a company and aren't aware, rightly so, aren't aware of the nuances that come with utilizing your company's bank account. There are certain things that you can, there are certain things that you can't do. There are forms to file, registers to maintain, other licenses to get depending on which sector they belong to. Often it's very reactive. In the early days, until they start seeing notices, they're perfectly fine. We've had so many businesses who come to us at a place where it's lakhs and lakhs of penalties and perhaps even a risk of imprisonment. And the founders are saying, hey, can you help us out of this? And we really wish we had advice earlier on. Now, this is incredibly important where people have to change that mindset in thinking that legal and compliance is expensive and therefore we postpone it to another day. It may be expensive initially, but it might seem expensive, but the pain that you kind of steer away from can save you a lot more trouble. Imagine this if they've built to a certain scale, but then you're rife with compliance issues. Access to capital in the future is an issue. And all of your mental bandwidth is really going the direction of dealing with regulators, justifying why that penalty shouldn't be paid. You would much rather just remain compliant.
Right. So following up to that, so oftentimes people can't afford an advisor like you. So in that case, what do early stage founders do? Like, how do they keep track of compliances? I don't think a lot of people know about compliances a lot. They incorporate a private limited and they don't know about the compliances after that.
Sure. This question is answered almost as simply as, if I was not well, what's the best thing to do? A simple answer, you would go to a doctor or the equivalent of a doctor if you believe in homeopathy or whatever else that might be. But the honest aspect is, there are people that are experts at doing it. And the only right thing is to go to them. I would genuinely steer people away from just heading over to ChatGPT or Googling something and saying, this is my business. What compliance do I need to undertake? If you actually look at the fine print, even when you do that little check on ChatGPT or the equivalents, it will tell you at the bottom that it's not a legal expert and you should be consulting one for that specific direction. And across price bands, there are enough and more advisors that can definitely help people. So I'm not saying that it is always going to be an expensive affair either. You do have enough and more quality advice in the market.
Got it.
And that's easily accessible today.
But I don't think that a lot of people allocate the budget for that. I think that's where the issue is. So people think that oftentimes it stops with the incorporation itself. So probably if you could give a price range around how much do they need for a compliance, at least in the first year?
Sure. This is just a ballpark. If you have an entity set up and just looking at the basic government fees that you're probably going to be paying, and you'd need a good auditor and a company secretary, you're probably looking at somewhere about 1 lakh. This is just a guesstimate. Obviously, different markets could have different pricing. But in the grander scheme, if you really think about it, founders will only think of it more from a place that for me to do my MVP, for me to build the roadmap to be able to hit market and go live, this is the capital that I need And that's very lean and very focused on the core product, as it rightly should be. Legal and compliance are generally support functions, but it's a good idea to earmark about perhaps 10-15% of your overall capital towards that direction. And it's more prevention is better than cure. It's the same fundamental. In our experience, we've generally seen people looking at about 10-15% at least towards that direction. They might not use all of it, but it's just better to kind of keep that.
Understood. So for a young founder coming from rural Tamil Nadu, that's where our mission is, right? Building global startups from rural Tamil Nadu. So what are the must-haves, absolute must-haves to be safe, firstly legally safe, and then to also be investment ready?
Sure. So as long as they have a good advisor, safety anyway comes automatically with that. And of course, risk averse is really up to each person in terms of how risky they want to play business. But I would honestly suggest, I say this to founders in general, the most important thing is really to look at it more from a simple fundamental of what is the problem that you see around you. You do not have to hallucinate a problem. Different zones of Tamil Nadu, for example, have significant strength in terms of what each of the towns or cities do, or for that matter, even some of the villages, are a source of specific things. And they should look at that as a strength and look at that to utilize what problems they could potentially be solving, which does exist in the market. Now, one of the toughest parts about identifying a problem, in my experience, has been people don't often complain about it at a forum that is easy for you to unearth. It could come from a very simple conversation at the breakfast table where your parents are ranting about something. Could come from a conversation at the bus stop where someone's talking about a problem. It's just about kind of building that little bit of data to yourself, understanding this is a problem to solve, and trying to solve that with the strength of where you're from. For instance, if you look at a certain sector which is manufacture heavy, don't steer away from manufacture. That's the strength of the geography you have. You could utilize that to be solving problems.
Understood. So speaking about problems and identifying an industry, right? So what I suggest is that there are a lot of consulting companies like Bain & Co, KPMG and so on, right? They produce a lot of reports, industry reports, and they spend millions in that, right? They have about like 20,000 employees, 30,000 employees just working on those reports to get a client who would pay, say, $500,000 a year. So do you think that it is advisable for startups to have these reports as a starting point to find an industry to work on?
You could. In fact, if you did a simple Google search on a yearly basis at least, you'd find a lot of these consulting firms putting out data. Even otherwise, there's a lot of other websites that actually throw out this data for free. Now, obviously, the accuracy of that data is potentially questionable. Not taking away from any consulting firm, but if you take it from the random open internet, you don't necessarily know if that is true. But of course, if you do look at a report that's put out by a certain firm or certain organization, that comes backed with references. Now, that's available today. You do not necessarily have to be engaging somebody to help you put together that data, which is already available. That is definitely a good start point. But what this does is two things. One, again, when you play with the strengths of the variables available to you to solve a problem known to you, you're creating problem, solution, and your job is then to join the dots. But when you look at data of what is available globally, you're looking at a very theoretical view of a problem. So you need to have that little test bed to understand how does this pan out practically? What does it look like practically? Are there people globally trying to solve this problem? And to understand the issues they are potentially facing. Now, when you zoom out and make it so large, it can also be very overwhelming and very easy to kind of get things wrong. Mm-hmm. But something very in your face is a much easier problem to solve. So it's also been a part of my investment thesis where the founders are generally very close to the problem and they've had a very real experience of the problem. Unless you've been at the receiving end of it, or perhaps have people around you that have been at the receiving end of the problem that you're trying to solve, I feel it's a little difficult to really get the ground reality of the problem you're solving.
Understood. Now, coming down to idea to the investment part, right? So, when does a startup become investable, and what are the signals you look for?
Sure. It really depends on the stage. If it's early, there are situations where it's an idea, and you also are betting on the founders then, right? It depends on how committed to the cause they are. For me, perhaps one of the largest of red flags are those, of course, I'm not taking away from the effort that a lot of founders put in, but people who continue to moonlight. That to me always tells me that they're not necessarily willing to kind of put their 100% behind the idea that they have. Of course, it can come from a lot of scenarios and a lot of situations where they might require that money to be able to meet their expenses and to run their life. But to me, that commitment that comes to that idea and taking a bet on a founder's capability to execute is perhaps early stage at the zone of ideation. When it comes over to a little more mature zone where they have an MVP or perhaps there is a little bit of revenue, it's about looking at the effort that went into it, the time to build that little product or the tech, and then to kind of look at, in my head, am I able to map based on the conversations with the founders? Am I able to potentially map the growth path for them? And what is that likely to take? A lot of founders, again, sometimes speak very in the air, where they're suddenly saying, if I have $5 million, which is a lot of money, I will be able to capture 1% of the market. If I capture 1% of the market, your shares are going to be worth so much. Now, I already know that's now something that's very, very 100 feet level and perhaps may not pan out the same way. I'm a lot more of a fan of people who try and take a shot at building data, try and build out that path for themselves, and they don't need me to do that for them, right? It's about support me and I will help you get to this zone.
Right. I think the issue is that we've glorified millions and billions. I think when it comes to India, at least, you have to understand that $5 million is not the number 5. It's about 45 or 47 crores, right? I think we should start talking in those words and really understand the Himalayan amount that is actually $5 million. Now, getting down to your core experience. So, as we stated out in the beginning, you worked with almost 170 deals last year in the private equity and venture capital space. That's worth about $500 million. That's phenomenal. So, first question, how do you deal source? How do you bring in those high quality deals? I mean, you could say that easily now because you've got the experience. But if someone is, say, starting out, so how do you find those high quality deals?
Maybe I don't particularly have the answer if I had to give it to you as an investor, right? Because I've not really gone out there searching for businesses to invest into. But whenever I'm out there at events or if I'm speaking somewhere, initially I think it came through a lot of people introducing me to different founders saying, hey, these are funding rounds that are happening. And with time, when I'm out at speaking at a panel or I'm out at a conference, it's just about meeting new founders who automatically have that curiosity in terms of saying, if you've worked a certain number of transactions, you probably understand what market standards are and could potentially protect our interests. That was one side of doing it. And I think there's also that little saying, which is when you aren't actively looking for something, you'll have abundance of it. So we weren't actively looking to deal source. We were just out there to understand the ecosystem, to kind of try and gain knowledge and to educate people, and automatically came a quality bunch of founders. But of course, you do have the other sets of advisors. You've got your auditors, you've got investment bankers who've been very kind to us over the years, where they loop us in and introduce us to founders wherever there's an opportunity.
Got it. Now, coming down to due diligence, right? Can you explain what is a data room, an investor data room? Why do you think that founders must have it right from the beginning as they start? And, how do they prepare it from day one?
Sure. This is a manner of remaining organized at the end of the day. A data room is literally just a little cloud space where you provide information in relation to your business to an investor, right? Now, it can be in different kinds of diligence. I'll stick to legal because that's a space that's very easy to explain. You'll probably have 8, 9 different buckets of zones that an investor might want to look at documentation in relation to. And think of it as you're about to receive an investment. And if they have about 400 line items of information for you to supply, you're then very quickly you're going to go run around and try and piece that information together. And that's perhaps going to be a very shoddy job in the last second. And that will present perhaps a bad image of the business to an investor and could potentially scare them away. Now, versus if you look at the other side of it, someone who's very organized from day one, who's thinking, I need external capital eventually. Now, if I've paid my GST on time, if I've filed my forms, if I've done my TDS on time, I've filed my tax returns on time, just keep those records, organize them, put them into folders, and it becomes very simple for you to just go ahead and grant access to that, perhaps with minimal effort in the last moment, just to present it better. And you get that entire data dump over to an investor's team who gets a very different insight at that point, that they're dealing with someone who is so organized that they know exactly what they're doing. Now, that can potentially also ease you in to getting the investment through quicker.
Got it. I think the issue with most founders today is that they start with thinking that all they need is a pitch deck, because that's what that's what they see on Shark Tank, or that's what they see on YouTube. That's where a data room comes, right? It's the pitch deck is only a part of it. So how do you conduct due diligence to these documents?
Sure. So I'll probably have to explain this more from the eyes or the lens of an investor, where essentially you make a requisition of data. You're asking for several data points from the target company. You're essentially, it depends again on the age of the business and how long they've been around and the stage of the fundraise. The further on you go, it becomes a little bit easier for the simple reason that there have been multiple rounds of diligence and there might be the benefit of a previous round's diligence report. But if it's an early stage, if it's the first check that a business is getting, you will have to provide all of that data over to the investors team. And what we would then do is to go through all of that against the law to see, is there a deficit? Were there certain forms that had to be filed which haven't? Was there some reporting that had to be done to a regulator which hasn't? And at the back end, we then inform the investor. Assume 20 different points show up. Some of them can be solvable. Some of them can be very grave mistakes, which can result potentially even in crores of penalties, which all need to be cleaned up. We've seen, honestly, 22 to 24, we've seen a lot of transactions fall off because of diligence. This was a zone where people called it the funding winter. But as much as that was the case, I feel people went back to fundamentals of genuinely looking up businesses, understanding what's in place, and taking a prudent call on whether they should or shouldn't. So this process of unearthing what is popularly called red flags or deal breakers is the process of diligence. And it's often in deal making, it's to identify the corrective measures to it as well.
Got it. Now, coming down to my next question, right? Structuring a deal. So, can you tell me what are the deal breakers that you personally see while investing, and what you advise the VCs and PEs, and also how do you structure the deal?
Sure. So, structuring can come from multiple requirements. Sometimes it's from tax efficiency. Sometimes it is if there's overseas capital that's coming into India. These are particularly zones where you might see structuring requirements, or perhaps you might even see certain startups where they have multiple entities, where when it's just the co-founders, it might be 2-3 entities for very specific reasons that might not even be interlinked. It's about arriving at that end product, which is where the investor is investing into one entity, which is the collective, right? And therefore, there's no simple straitjacket answer. It's almost as simple as going over to a tailor and having them make you a shirt that fits you. Now, that's specifically made to you, and that'll probably not work for me. But from that perspective, of course, we've seen a lot of people who've taken compliance a little too lightly. Generally, at least in personal investments, I steer away from those that have entirely looked at even bookkeeping, for that matter, accounting, all of that. If the first couple of years they've really just pushed that to the end and just chosen to not really work with advisors, it makes me really think about how they've approached remaining lean. Now, remaining lean implies that you have your essentials in place. It does not mean that you skimp entirely on something that can come back to hurt you. This amplifies. This has also been the case through diligence. Oftentimes, when people have taken capital from overseas, sometimes they don't know that they have to actually report something to RBI. These are situations which you do see every now and then. If they're in sectors where it's automatic, you can still regularize that by trying to go to the regulator and saying, I should have done this, but I'm doing it now, and there's a penalty to that as well. But this is something which is quite common, and you do see a lot of lapses in reporting to the Ministry of Corporate Affairs, which means your forms aren't filed on time. Some issues within the forms in itself. So these aren't zones that necessarily make investors step away, but will call to action for that cleanup ahead of the investment.
Understood. Now, coming down to my last few questions, right? So you've invested in multiple startups personally. Now, how do you support founders post-investment? And do you think that founders should go to investments just for the capital, or should they also go for post-investment advisors? I mean, if you look at the early stages of Silicon Valley itself, it would also be the first investor who would also be bringing in the first few customers, right? So I don't see that happening in India. So what do you think about that?
Sure. You probably could have seen this a little earlier on. Right now, this space is so flooded with access to capital that it's perhaps just capital today. You do find a lot of businesses that are getting funded today, which also comes with smart capital, for that matter.
Can you define smart?
Smart capital being that, let's say that it's a legal tech business, for example. And if their customer base is going to be law firms, right? And if I was going to be investing into that business, the obvious value that I bring to them is the network that I have among other legal firms as well. And perhaps that could reduce the customer acquisition cost. Now, this is just an example, a hypothetical one. But this is a zone where it's not just the capital that I probably would have provided to that business, but I'm opening up network. And you do often see a lot of investors who make these investments who perhaps also have within their network quality VCs and perhaps the path beyond as well. Generally, founders who are first-time founders are the ones that perhaps may feel they require more guidance from someone who is within the same sector, who's been there and done that. You might see them either turning to them as advisors or going to them for that angel check. Very normal in the market. But you also do see the other side of this, where you do have folks that are not particularly putting in capital with the intent of being able to also assist them on the growth. It's just for the pure financial gains. There's no right or wrong to this, but ultimately it depends on what the founders require. Just one last piece on this. If you actually look at people who've sold their businesses and gone on to become a second or a third time founder, they are lesser likely perhaps to require that kind of support. If they are within the same superset of the zone that they've occupied, having kind of been there and done that to some extent, there comes only one of two possibilities. Either there's the arrogance to the fact that, hey, I know the space better than others, I don't need the help. Or two, I've done it, I had my learnings, I've made my mistakes. If I need guidance, I know where to go, and I don't need capital for that guidance.
Right. So speaking of, I don't need capital. Can you talk to me about bootstrapping? And I personally feel that bootstrapping is essential. It is crucial because you won't be getting funds from everyone today, and neither do you have to. It doesn't make sense to get funds early on.
Sure, of course. See, honestly, maybe akin to a lot of things that the current generation has been coining terminology for, startup is honestly just a new term that's being utilized in the market today. If you look back to a lot of family run businesses in different parts of Tamil Nadu, for example, of course, it's rampant all over the world. But if you look at a lot of these businesses, for instance, you head to Coimbatore, you look at the kind of traditional businesses that have existed, people don't even know how half of them exist. Some very, very famous brands that perhaps even export are even supplying to different parts of the country. They're all purely run by family capital. And it didn't start with a lot of capital, right? They did it the traditional way of taking loans from banks, sometimes collateralized, sometimes not. Pure focus on unit economics, right? Pure profitability. If they could do that for several years, I don't see why a startup can't. Did they disrupt back in the day? Of course they did. They must have gone through their own challenges. And every time we sit with different promoters and talk to them about their journey, we realize this is not much different from the startup world today. But back then they weren't chasing VCs, they weren't chasing capital. Sometimes even fundraisers today happen because of the FOMO, where founders think that a goal, an essential goal in the startup's journey is fundraise. But if your business speaks for itself, you're growing at a certain pace and you're content, and you know that growth can still continue, and if you feel you have that secret sauce to go, you've gone from 0 to 10, maybe you need guidance to take you from 10 to 1,000, but you don't need capital, it's okay. Perfectly okay to not raise funds.
Got it. I think we don't focus on unit economies a lot. So the issue with unit economics is that a lot of people think that cash flow is enough. They don't get into the finer details of it. They don't break down into they don't break down into COGS, or they don't break down into CAPEX and OPEX, and they don't focus on increasing the net profit margin. Like ultimately, it all comes down to keeping how much money is in your pocket. So can you talk to me about very, very crucial unit economics that you see that matters a lot with startups?
Sure. See, I think it, maybe before I get to the unit economics, I think it really comes down to how streamlined they've been on fund utilization, right? I think one of the biggest problems for why a lot of businesses fell off, when I say unit economics, it's the entire journey, right? How do you deploy the money that you have available in a manner that results in better earning to you, right? Now, what that would mean is you can't go berserk with your hires. You can't be paying a crazy premium when you know fully well that the capital available with you will not sustain that. Right. You saw so many layoffs post 2021, so many businesses completely falling flat post 2021. One of the single biggest reasons, from my reading, is really the fact that people overhired at crazy prices. That's zone one. Looking at how the team is constructed, how lean it is, how expensive that run is, backing that up with how does that translate to the product that you put out? How do you streamline your customer acquisition cost? And post that, what do your margins look like? Now, if this entire zone, this entire journey is solved for, I've oversimplified it, but when you look at that entire journey, you then come to your profit before tax. That is, after you remove all the expenses, you then need to focus on post your taxes getting removed, where remains your profitability and what do you want to deploy that into, right? Because if you've not been frugal, if you've not run it like a tight ship, the assumption that any person external to the organization will have is that that profit may also not get deployed in a manner that makes complete sense. Now, obviously, you do have some businessmen that are very, very risky in the way they do things, high risk and high reward. But the trickier part is ensuring that you have a method to that madness.
Okay. Now, coming down to my the third section of this podcast, rural innovation and the future itself, right? So we've seen a lot of tailwinds come and go. We've seen Web3, we've seen SaaS, at least in the recent days, and then coming down to AI now. And I think AI is evolving faster than anything right now. So we had the general AI, like we had ChatGPT Perplexity come up with chatbots, and then we had it going to generative AI. Then right now we're at the space of agentic AI. So India is entering the AI, the decade of AI. We are trying to build our own LLMs here. So what trends do you see coming up in venture capital, and what kind of innovation that you are most excited about?
See, honestly, I'm seeing a lot of movement in the AI space. This is perhaps currently, at least in the sectors, comparable to what fintech used to be back in the day, where if anyone said fintech, they would get a check. Today, the AI space is getting flooded very quickly with stuff that is repetitive, stuff that is competitive to each other. But there is genuine innovation as well. To me, a zone of genuine excitement is around the legal tech, the legal AI space. A lot of people in my line are genuinely nervous, scared of the fact that AI could potentially replace maybe 60-70% of what we do. That's very real. It's very true. But it's about embracing that, trying to utilize that to our benefit of identifying people that are building tools which can also serve our purpose of being able to deliver better value back to a client. Now, that's a zone why I live that zone every single day and can genuinely relate to it. And therefore, that's a zone that's of true excitement to me. Another thing which I genuinely was excited by, I saw a little news article which spoke about the fact that we now in Chennai have a few signals that have cameras and some tech around it that automates how signals function, and that's driven by AI. Now, it's really exciting to see having lesser human intervention and tech that can actually problem solve and make our lives that much easier. Every single day, driving to office, I'm whining. There are 3 signals, 120 seconds each. Imagine that. That's a lot of fuel that's utilized. That's pollution we're creating, time wasted. And sometimes I even see that situation where it's a red signal, no one's moving from our side, and no one's moving on the other sides as well. It's empty, but we're just waiting. So I think this is really a step in the direction of the future. And I feel this is all going to have cascading effects. You do have the aspect of how it can energy save. How, of course, that's the different side of it, is where people are talking about how if you go and put out a prompt on ChatGPT today, you're probably causing for a bunch of water to be utilized. Right. Now, that's harsh reality, but there are tweaks to this as we speak. People are working on making that more energy efficient. And I feel 5-10 years down the line, if we get to a zone of energy efficiency, the problems that AI can solve for us can genuinely be really, really tangible. That's something I look forward to.
Got it. So where are you using AI right now?
Pretty much all through the journey. I think it starts from as simple as sleep monitoring, my workout monitoring. Of course, there are fitness bands that help you do that now with an app in the background. Starts from there, all the way through to the workouts that I do, monitors that as well. And then I get into work. Work is heavily AI driven today. Our workflows, some parts of that are automated in terms of also some of the mundane work in terms of proofreading, in terms of how do you ensure that a document has the right grammar? How do you ensure that it's formatted right? As much as there's still a reasonable amount of human intervention today, I feel the AI that we are also trying to implement and use at work forms a large part of my day, because that I do that 12-14 hours a day, so that I don't think there's any part of the day that's AI free.
Got it. And I'm sorry to disturb that 14 hours of work schedule today.
Not at all.
So coming down to the next part, I want this from your lawyer's perspective, right? So where do you think the AI regulations are going to go? Do you think that it's going to be as free as it is today, or do you think that there will be insane amount of regulations coming up soon?
There are two things here. I look at them in two different buckets. You've got regulating what AI can do and can't do. And of course, creating a rule set to it. I definitely do not foresee that they're going to ban something like this. This is it's a necessary evil. I would say it's evil just from perhaps the downsides that it can offer. But aside of this, you also do have the data protection side of things, which is very, very critical. Today, how do you ensure privacy? How do you ensure that some of the information that is fed into AI today is not misused? I feel these zones will definitely get regulated. It's all in the works. Around data protection and privacy, you do have enough and more around the new law that exists today. It's not yet fully implemented. But yes, I do believe as technology evolves, the law attempts to keep up. There's no way that you try and beat existing laws into having to deal with new technology. So it's an inevitable thing. It perhaps will not remain as free as it is today. It will, in my opinion, get reasonably regulated.
Okay. Now, you mentioned that the law evolves as the technology grows. Could you give me some example from the Indian government or the Tamil Nadu government as to the laws that have evolved?
Sure. See, perhaps one that you can just off the bat look at it. I will probably look at it as central law to begin with. Just look at the data protection piece to begin with, right? The earlier enactment we had was back from the year 2000. And was that fully well equipped to deal with the technology as it is today? Not really. And there have been enough and more privacy concerns, a lot of issues around personal data and how a lot of businesses have misused it. Today, it's as simple as you have absolutely no clue where you and I have been speaking about a certain product, and suddenly you're scrolling through social media and you'll find those ads right there, right? And it's about regulating these things. It's about making sure that there is some safety to you. There is some safety to things you do, things you talk about, your data, right? A huge step in that direction is the DPDP, which is your data protection enactment. This, of course, was in the works for quite a while, and it's largely also modeled on the GDPR from the European regime. But obviously, it's built more to the weather, the climate of India. And this is a huge step. And we also have to understand that India is a way larger geography. You're dealing with a multitude of culture. There are a lot of sensitivities. It's not as simple as building regulation to a small country. And I think the regulators have done an incredible job in trying to keep up with the technology. Perhaps a zone that could have moved quicker is probably around the Web3, the cryptocurrency space, where you do see some forward markets like UAE and Singapore that do have clear regulation today. Does India have that yet? Perhaps not. We yet don't know if there will eventually be a ban or what direction they're looking. Just one bit of silver lining was the fact that now they're taxing gains that come out of crypto, which means the positive underlying tone is they've not banned it. Mm-hmm. So maybe they're open to that technology, that is the blockchain, to see value in it, to see where it can take us, which is perhaps why it's not been outright banned today. So it takes time, but it surely should deliver.
Understood. So getting down to these very important questions, right? So first things first, you're a lawyer, you run a law firm, and sales and negotiation is, unarguably one of the most important things as part of your journey. Could you give me your lessons from sales and negotiation?
So, see, honestly, I think as lawyers, we've got our bar council regulations, which teach us a lot, right? It's the fundamental of what we should be. And at the end of the day, we're out there to protect our clients' interests and to do the best we can possibly for them. Now, one thing that I learned over the years of negotiating many transactions is you need to be like water, right? You need to take the shape of the container that you're required to fill. Now, if I need to be incredibly aggressive in a negotiation, and if that's what the founder or the investor requires, that's what I'm going to have to be. And if I need to be a little calmer, hear the room out, react to them patiently, that's also what I have to be. Now, what that kind of taught me, initially there was natural resistance for me in kind of looking at it with tunnel vision of saying, this is my personality and I can't really change that. I'm generally very quiet, soft spoken. I'm not necessarily someone who can fight you on something. But I realized I'm not able to deliver to what the client genuinely deserves then. So negotiation is more an art, it's a skill. It's sometimes a soft skill, but sometimes it's an essential. Actually, more often it's an essential. So it really comes down to every single conversation that someone has with another person is in some form or the other a negotiation, right? I have a view, you have a different view. We're probably navigating to understand where we find our middle ground. Now, it also is important to read the room to understand what the person you're negotiating with is responding to. If they are getting antagonized by things you're saying, it's important to kind of tone that down a little bit. So it's being measured. It's about choosing the losses that you're willing to take for the bigger win.
I focus on rural Tamil Nadu. So, what is your opinion on rural Tamil Nadu? How do you think it's going to evolve? And what are the mindset shifts you require from a founder from rural Tamil Nadu to, potentially invest in him or her? And also, please provide me the validation that a person from rural Tamil Nadu does not have to move to Chennai or Bengaluru to build a startup.
Of course, I mean, you do have quite a few examples out there of businesses that have been born out of not Chennai in Tamil Nadu. And it is, perhaps one that you can look at is Zoho, right? It's very out there. Incredible brand. I think their facts speak for themselves in terms of how well they've done. You do have a lot of other businesses that were born out of the smaller towns, the villages. Of course, if you look at your farm to table businesses, where does that procurement come from? It doesn't come from downtown Chennai. It doesn't come from the central zones of Chennai. That procurement comes from somewhere, and that's usually interior Tamil Nadu. Now, the only mindset change that perhaps they need to cultivate with time, it's not an easy one, but to first understand for themselves that they are not inferior by any stretch or measure. They, in fact, know a lot around business. They know a lot around what they do, way better than any one of us sitting here, right? And the more you speak to some of them, they get intimidated by jargon in the space. They get intimidated by things that perhaps a VC might say. They get intimidated by, you talk about rights, you talk about the kind of quantum of money. But if you sit down and understand in simple words, what do they do? How do they focus on making money? How do they focus on paying the people that work with them? You will actually understand they know the concepts of business inside out. They know it way better than a lot of people that we might perhaps interact with. And language should not be looked at as a barrier at all. There are several business people that we've interacted with through this journey, but I've genuinely seen some of the founders who get a little too intimidated when they're in a room with people speaking a different language, perhaps English or Hindi. They're thinking, if I head over to Bangalore to ask for capital from a VC, why I'm saying Bangalore is that's a genuine hub. And if they head over there, their concern is, at least through 2021, we did see term sheets come with a precondition saying you need to move over to Bangalore to be able to do this. Now, imagine when you have data of businesses that have flourished from wherever they've started. It does not have to be a metropolitan city, does not have to be one of those prominent hubs that the world knows. A lot of these businesses can be born out of zones where you have that strength that exists in the zone. For example, if you look at something which is around the cotton belt, you'd want to leave them there, right? Procurement is right there. All you need to solve for is the logistics of how do you move it from there to different parts of the globe. But that quality of the work they put out speaks for itself. They've remained profitable as a sector. They've genuinely functioned way better than a lot of other zones. They know better than a lot of people who've tried to do this in urban zones and have failed, right? And even if you look at larger brands, why I'm focusing on this segment is I've also done a little bit of research on it. Manufacturing clothes, for example, you do see certain zones in Tamil Nadu which excel at it.
Especially the Congo belt.
Exactly. And a lot of people literally just get it white labeled from over there, put their brand onto it and sell. Now, there shouldn't be hesitation for these guys to do it themselves. It's not so hard to build that brand out.
I think companies like Zoho, as you mentioned, Milky Mist, Ramraj, for the matter of fact, I think all of these companies have been a testament for whatever you're proving.
Absolutely. And if they could do it, absolutely anyone else can.
Exactly.
The only thing that set them apart is they believed in themselves and they just did it. It's sheer effort.
Got it. I think I'm done with my questions. Probably a few rapid fire questions that I just that just came into my head right now. So, coffee or tea before pitch meetings?
Coffee.
Why?
Wakes me up.
Got it. One Tamil Nadu founder everyone must follow.
This is a gentleman, Pritesh. He is Coimbatore based, the founder of Juicy Chemistry. He and his wife both, Megha.
Got it. Yeah, I think these are the two main questions that I wanted to ask. I've got three more. A book recommendation?
I'm currently reading one called it's by Mel Robbins. It's basically called Let Them. It's a very interesting revelation. It's redefining me.
Movie?
Inception.
Okay. Podcast?
Nikhil Kamat's.
Got it. So I think that'll be it. Thanks a lot for being here, Karthik. Thank you. Hi, I'm Dakshin, the founder and managing partner of FounderX Venture Partners. So we built the world's first fully residential venture studio specially for agentic AI startups. So we are launching a 120-day program starting this September till December, where you will get to find your co-founder and build an agentic AI startup. And our mission is to build global startups out of rural Tamil Nadu. So check out founderx.club/residency and apply now. Applications closing on the 18th of August.